Hello, this is Mr. Ayazuddin S Khan from Pune, Maharashtra State, India. Last time we discussed capital asset. That is very important phrase as far as income tax is concerned. The knowledge of capital asset is not enough without getting the knowledge about long-term capital asset and short-term capital asset. Both are related to capital asset. Or capital asset, we can say capital asset is related to these two things. That is long-term capital asset and short-term capital asset. Long-term capital asset and short-term capital asset, before we go to discuss these two phrases, we must be aware about the government's intention, or rather objective, of dividing this capital asset into these two things, that is long-term capital asset and short-term capital asset. So let us find out the government intention, or rather their objectives for classification of capital asset into two categories, that is long-term capital asset and short-term capital asset. The first and foremost objective of the government as far as short-term capital asset is concerned, they want to keep the investment market going, or they want to keep the investment market active. They want to give wider scope to the investors to play in the investment market. To play in the investment market, I mean, government has given more scope to them for doing the activities of buying and selling of capital assets in the investment market, and they can earn the income. Government can also get the tax in the form of tax on capital gain, and many other people connected with the investment market, they are also happy for their earning. This is the first intention of the government, to classify capital asset into these two categories. The second objective is, there are different tax rates for long-term capital gain and short-term capital gain. There are different income tax rates for taxing long-term capital gain and short-term capital gain. So for this purpose also, that government gone for this classification. These are the two objectives we must remember. With these main two objectives, the government has classified this capital asset into these two varieties or two categories. Now, let us go to see what is what is long-term capital asset and what is short-term capital asset. Long-term capital asset, as the name suggests, it is you have that asset with you, or you are the owner of that asset for a long time, for a long time. This is the simple meaning we can have, or guesswork we can have. But law says the same thing in other words, in other different words, but the import is the same thing as you guess. That is, somebody has hold or is the owner of that asset for a long period, early in the period. So, as per law, taxation law, long-term capital asset mean that asset which is not short-term capital asset. Long-term, see the law, how law is mischievous and how it put people, or rather those interested in taxation law, in puzzle. This is the wonder of this taxation law, or for that matter any law. Law should be, drafting should be simple, and where such type of diplomatic words and this what you call, where you cannot have the meaning instantly, and you are forced to learn another term to understand the first term. You followed? So anyhow, this is we have to move on with such things, and there is no other remedy. Some reformist comes, tells to the department and government. So wherever this is the law can be many provisions of law. Any law can, and that too in particular Income Tax Act 1961. Many provisions of the act or law can be easily explained to the reader with illustration or with examples, simple examples. Anyhow, this is my view, and your view and my view. This is only our view only, and when government takes into account such views, let us see. Anyhow, taxation law says, long-term capital asset means the capital asset which is not short-term capital asset. Then we are forced to learn short-term capital asset to learn the long-term capital asset. It is there. So necessarily we have to move to short-term capital assets. And what is short-term capital asset? Again, in a simple guesswork, it means you are the owner of that capital asset for a short period. It is a guesswork. And law also says the same thing. A short-term capital asset, that is, if you hold that, hold means you are owner of that capital asset for up to 36 months from the date of its buying, from the date of its purchase, that capital asset, whatever capital asset, we have seen the various types of capital asset during the last lecture. So this what you call, if you hold this capital asset, or you are the owner of that capital asset for 36 months, and these 36 months we have to count from the date of purchase of capital asset, or date of buying of that capital asset. That is, we have to include in the holding period this date, which purchase date. Remember this thing. We have to include buying date in the holding period. So if you hold this capital asset for 36 months, and after 36 months, suppose today you complete 36 months and tomorrow you sell this your capital asset, so that becomes your short-term capital asset. This is the law, income tax law says. you have purchased, you have bought some capital asset, and tomorrow you are selling that asset. Sometime back you purchased that asset, capital asset, and you are selling tomorrow. And that period, the date you buy or the date you bought that capital asset, and tomorrow you are selling. So today that period of holding should be 36 months. In other words, buying date we have to hold, in the holding period we have to add the buying date as well as the date, today's date, up to today, because tomorrow you are transferring, you are selling that capital asset, so you are not no more holding, or you are no more whatever owner of that capital asset tomorrow. So buying date and this today's date, the date before the sale of asset. This date, these two dates you must remember. You have to add this buying date in the holding period, and you have to exclude the date of selling. Tomorrow you are selling, so you have to exclude that date of selling in the holding period. So counting of holding period to classify particular asset into long-term capital asset and short-term capital asset, it is very important work. It is very important work, or it is important thing for us. So remember, while calculating holding period of any capital asset, to know whether it is long-term capital asset or short-term capital asset, we must remember that in the holding period we must include the buying date, the date on which you purchase that capital asset, and you have to exclude the date on which you are selling your capital asset. So there is inclusion and there is exclusion. The date of purchase, the date on which you purchase that capital is to be included, added, and the date on which you are selling that asset, that date is to be ignored for counting the holding period. So that is to be excluded. In legal word, it is to be excluded. So this way we have to work out the what you call holding period of any capital asset, and then we can come to the conclusion, and we can find out whether that particular asset for which you have counted holding period, whether it is long-term capital asset or short-term capital asset. So we are now discussing short-term capital asset. So basic rule, Act says, basic rule is like this: if you are owner of that capital asset for 36 months, or in other words, if you are holding that capital asset for 36 months, then it is your short-term capital asset. It is your short-term capital asset. So this is basic rule. Then as we have just now we have discussed the objective. The first objective of classification of assets into long-term capital asset and short-term capital asset is to keep the investor in joyful mood, give him the boost, encourage him to do more and more buying and selling activities of capital asset in investment market. That is the basic intention of government to classify this capital asset into two things: long-term capital asset, short-term capital asset. So this 36-month holding period is 36 months, then that capital asset becomes short-term capital asset. But as that intention of the objective of the government to keep the investor in happy mood, and their market should be very hot and active, and what you call rolling, going market. So, and to make the investor what you call do more buying and selling activities of the capital asset, government has, for some capital assets, government has reduced the period of holding from 36 months to some specified period. Government has reduced. This is to achieve that objective. To achieve that objective. What is that objective? Objective to keep the investment market going and keep the investor in happy mood, make him more active, and encourage him to do more buying and selling of capital assets in the investment market. They have reduced, government has reduced the holding period for some capital assets, and though their holding period is not 36, still they are short-term capital asset. And why this is so? Why reduction is there in the holding period for some assets? That is this is to encourage the what you call investor for investment purpose, or buying and selling activities purpose. So then we have to go ahead and see what is that concession government has given to call a asset, capital asset, a short-term capital asset. Then there should be holding period of 36 months. That is the basic rule. But what is the concession or reduction of holding period for some capital assets government has given? So let us see. Let us see which capital asset enjoy this what we call reduction period to be qualified or to be called as short-term capital asset. So in that context, first capital asset is equity share. First capital asset is equity share. So equity share first. Then what is the second? Then unit of equity oriented fund. Unit of equity oriented fund. Then there is what you call zero coupon bond. Zero coupon bond. We'll see. Nothing to worry. What is equity oriented fund and what you call zero coupon bond, that we'll see. But just remember this thing, that reduction period for holding a capital asset that we are discussing now. So basic is 36 months. Then reduction government has given to some capital asset short holding period, and in that context, first is equity share, second is unit of equity oriented fund, third one is unit of business trust, third is equity, this zero coupon bond, third is zero coupon bond. These three what you call capital assets, these three capital assets enjoy the reduction period of holding. And what is the reduced period of holding for these three what you call capital asset? This is 12 months. If you are owner of that asset, any of these three or any one of them, if you are owner of that capital asset, even for 12 months or less than 12 months, then it is your short-term capital asset. Even you are not holding for 36 months, but you are holding for less than 12 months, up to 12 months or less than 12 months. So it is your short-term capital asset. So these three capital asset enjoy the reduced holding period that is given by government, and intention is, I should not repeat again, intention that thing to keep the investment market in a healthy and hot conditions, and there should be lot of investment activities in the market, and investors should be happy and do more and more buying and selling activities. That objective you must always, I am repeating, please you also remember this very important objective. So once you get the objective of the government, then this thing become easy. Which things, this whatever we are discussing now, reduce period of holding and all these things, it will become easy. And not only they have what you call reduce the period of holding, 36 months to whatever, but they have what you call they have reduce the tax rate also for them. See, they have reduced the tax rate also to achieve that objective. Not only holding period is reduced, even tax rate is reduced. Tax rate is also reduced. It is brought down to minimum as compared to other rates. So this much what you call encouragement government is giving to what you call to investors, and that is why. And you know what he does there, or he buys and sells the capital asset, and we are discussing that important thing. So these three capital assets, that is what you call equity shares, then unit of equity oriented fund, then your zero coupon bond. These three capital assets has got the holding period of 12 months to be called them as short-term capital asset. Then then comes next capital asset, that is unlisted shares. All these things will unlisted equity oriented fund and business, the zero coupon bond. This we'll discuss in this lecture only. But this broadly you remember what I am now discussing. This unlisted shares and immovable property. Immovable property means your open plot or your structure on the open plot, or your shop, your home, land, home, or both, like this. So we have seen this type of capital asset in last lecture. So unlisted share and immovable property, if these two assets or any of these two assets, if you are owner for 24 months, if you are owner for 24 months, then that your capital asset, either what you call either unlisted shares or your immovable property, that becomes short-term capital asset. That becomes short-term capital asset, not 36-month period. Basic rule is that asset, if it enjoys 36 months holding period, then it qualifies to be called as short-term capital asset. But to achieve their objective, the main objective, government has prescribed or given the reduced holding period for some capital assets, and in that context we are studying, we are actually getting to know this what you call unlisted share, holding period for unlisted shares and holding period for immovable property. These two capital assets, the reduced holding period is 24 months. That you must remember. So this is the 5 capital asset, they enjoy the reduction period given by the government. So we must remember this. Now, will have some short discussion on that is what you call unit of equity oriented fund. This thing, unit of equity oriented fund and debt oriented fund, there is another variety, debt, D-E-B-T, debt, we call it debt, we pronounce rather as debt. Debt oriented fund and equity oriented fund. So, as far because this phrase has come, this capital asset, unit of equity oriented fund, this fund, mutual fund, what they do, they actually take the what you call investment amount from the investor, and they invest in what you call equity shares of companies, incorporated companies. They invest in equity shares of some profit making companies. They don't invest in other things, bond, debenture, or preference shares or other things. They don't invest there. They invest in equity shares. Who? These mutual fund people. So, this taxation law says if mutual fund invest its investment amount in equity, what you call in company, in the equity shares of some company, profit making company, and that amount is equal to 65% of their investment amount. If that investment amount is equal to 65% of that investment amount, and that company is that mutual fund is investing in equity shares, so that that thing, and if you give unit to the investor for collecting the fund, so that is unit of equity oriented fund. So whatever fund they have collected, they are equity oriented. That means they are collected only for investing in particular investment area, that is equity shares of profit making company. So mutual funds, they take the investment amount from the investors, and with their knowledge, investors' knowledge, they invest that amount to the extent of 65%, whatever they have collected. Then out of that, 65% of the collected funds, investment amount, they purchase equity shares. They invest in equity shares of profit making companies. So that is why their fund collection, that name is given equity oriented fund. So that fund has got orientation. Orientation means direction. It has got direction towards equity shares. It has given, just like a soldier, he takes the gun and rather check his target, and actually he fixed the target by lifting the gun. So like this mutual fund, when they have the funds from investors only for, with their knowledge, only for investing in equity shares, and that fund, they call it equity oriented fund, and the unit they give to investor is what you call it is unit of equity oriented fund. This is all about, in short, it is about equity oriented fund. Then there is zero coupon bond variety. This is capital asset, zero coupon bond. That taxation law says what is zero coupon bond. You normally bond, there is bond period is there. So whenever government issues bond, some bond, so they give high rate of interest because investment is because investment period is long, it is lengthy, 10 years, it runs into 10 years, 15 years like this. So government also gives what you call higher rate of interest to the investor in their bond. So they get the periodical return. What I want to tell or press here or highlight here that investor who invests money in bond, government bonds, so he gets higher rate of interest. He gets the interest from the government on the bond. So this what you call zero coupon bond, though it is government bond, but that investor doesn't get anything, no periodical interest payment to him. This is the speciality of this zero coupon bond. Zero, name is given zero. That investor should expect only zero, zero amount of interest periodically. So government doesn't give any what you call interest to him, the investor, and he cannot take back his amount also. Normally, he cannot take back his amount also before maturity. So this is the investment is for longer period. One thing, then you don't get anything from the government in the form of interest. Then third thing, you have to wait for a long time to get back your what you call basic amount. Your basic amount, they call it principal. Basic amount plus interest, accumulated interest. Year to year, government has calculated the interest and credited to your account in their books. They are credited to your account. So interest on interest. So the amount at the time of maturity, when the date of repayment comes, because this is already decided, date of repayment or date of maturity, date of repayment is already decided. On that date, that investor gets big amount in the form of repayment. That is, whatever amount he has invested, that amount plus interest that he earned and credited by government to his account. All these things, the interest plus his what you call investment amount, both becomes very put together. That amount becomes very big amount, and investor, because his choice, his liking, his preference for that thing, so he gets but he has to wait. He got everything. It is because it is promised by government. He gets everything. So your zero coupon bond, we have to understand in this way that investor doesn't get interest before maturity periodically. He doesn't get periodical interest as in the case of regular bonds which government issues to investor. Here in this zero coupon bond, investor doesn't get periodical interest, one thing, and second thing, he has to wait for the maturity period or the period decided for repayment of his amount. So this is about your zero coupon bond. So these 5 capital assets, they have got a reduced holding period. As we have seen, the reduced holding period for these equity shares, unit of equity oriented fund, and zero coupon bond, holding period only 12 months. Then come unlisted shares and your immovable property. For them, holding period is 24 months. So all these things done is done to achieve that main objective of the government, to make the investor to do more and more investment, that is investment activities means do more and more what you call buying and selling activities in the investment market. That is the objective they want to, and keep the investment market hot and going. So they have, for this purpose, some steps to be taken. So these are the steps government has taken: reduce the holding period, and reduce the tax also, and achieve the objective. That way they are doing. Anyhow, so now unlisted share means shares not listed on recognized stock exchanges. Shares not listed on recognized stock exchange. That the share which is not listed on recognized stock exchange, that share is called unlisted share. We call that share as unlisted share. So we have seen these 5 capital assets enjoy the reduced holding period. Basic rule is 36 months. Then for some capital asset, government has reduced the holding period, and that we have seen. Now we'll go ahead and we'll see the importance of this holding period. Holding period, the importance lies, basically it lies in the he comes to know why one should learn, or why one should, or investor should know about this holding period. So for this knowledge, whether his capital asset is long-term capital asset or short-term, whether his capital asset is short-term capital asset, that he must know. And when he will come to know whether it's long-term or short-term, when he find out the holding period before sale of his that capital asset. So for investment it is important, because only holding period will give him idea about the type of capital asset he is holding, whether long term or short term. This is first importance for the investor. Then second importance of holding period is like this. So once he finds out himself what is my holding period, whether my asset is long term or short term. Once he finds out that thing, then only he will come to know at what tax rate he should pay the tax on capital gain. After getting idea about his capital asset, whether it falls in the category of long-term capital asset, or whether it falls in the short-term capital asset, after finding this, then he will come to know at what income tax rate he has to pay the tax on capital gain that may arise from sale of his long-term capital asset or short-term capital asset. So this is the another importance of the holding period. Investor gets the fair idea about the tax rate. Investor gets the fair idea about the tax rates. At what tax rate he has to pay the income tax to government. That way. Now, after discussing this importance of holding period for investor, now we'll move to tax system. or tax rates. Tax rate as government has given for this what you call long-term capital gain and short-term capital gain. So this long-term capital gain and short-term capital gain, as we have seen, long-term capital asset. So if you are owner of some long-term capital asset, if you are owner of some long-term capital asset, that is a capital asset which you are holding for more than what you call 36 months, because basic rule is 36. Basic rule is if you hold or you are owner of that for 36 months, it is you are holding that asset for short period, and that your asset is called that you can call that asset as short-term capital asset. Okay. So now long-term capital gain, it means when you sell your long-term capital, any long-term capital you sell, then whatever profit you earn or you gain, that becomes long-term capital, what you call long-term capital gain. That is called, we call it as long-term capital gain. Okay, now we'll go to short-term capital gain. So short-term capital, there are short-term capital gain means when you sell your short-term capital asset in the investment market and you earn some profit. You earn some profit on that capital asset, on that short-term capital asset, then that profit or that gain becomes your short-term capital gain. So long-term capital gain and short-term capital gain. So long-term capital asset, you must know, the asset which is not short-term capital asset is called long-term, and then by force or automatically we are pushed to short-term capital asset. We are pushed to know what is short-term capital, because it doesn't teach who I am. Okay, long-term, this long-term capital asset. It doesn't give any information about himself. So this is the fun. Okay. So short-term, we have learned short-term capital asset. Any asset, if investor holds that asset or is owner of that asset for 36 months, then his asset, that asset becomes his what you call short-term capital asset. And apart from this basic rule, there are reduced period of holding for some other capital asset that we have already discussed just now. So accordingly, if you sell that short-term capital asset in the investment market, and if you earn something, some profit on sale of that capital, short-term capital asset, so that becomes your short-term capital gain. So long-term capital asset and short-term capital asset. Long-term capital asset, for example, just I will tell you, I think the asset which is not what we call the asset which is not short-term capital asset is called, or that asset is what you call a long-term asset. So this holding period, maximum holding period 36 months, if investor, for example, I am giving example, if you have got land, open plot in some city, so that you are holding, you are owner of that open plot for more than 36 months, more than 30 months. So that plot is your long-term capital asset. Just example. This way we have to work out anything more than 36 months or as per this period, which reduced period. If above reduced period, then automatically it falls in the what you call long-term capital net. Automatically goes to that category, long-term capital asset. Anyhow, so this is about what you call long-term capital gain and short-term capital short-term capital gain. Then what are the rates for? First, we will see the what you call tax rate, income tax rates for short-term capital gain. And we are doing again, I am repeating that thing. Government objective, main objective of keeping the investment market in the what you call in the happy mood, moving, going on activities, what investment activities, and investor to keep the investor happy. So, with that objective, that this reduced holding period, now we are discussing tax rate for short-term capital asset. Then, what is the tax rate for short-term capital asset? Here also, for what we have to understand, there are short-term capital asset and there are income tax rates. There are short-term capital gain arising from sale of short-term capital asset. There is what you call short-term capital gain arising or you get from sale of that short-term capital asset, isn't it? For that thing, what you call tax rate is different. For some short-term capital gain, income tax rate is different. For some short-term capital assets, income tax rate is different. This is basic thing, you remember it. So, now let us see tax rate, income tax rate. Let us see what you call, we'll see the specific income tax rate for short-term capital gain. There is general income tax rate for short-term capital gain, and there is specific income tax rate for short-term capital gain. There are two things, two tax system, two tax rates. One for short-term capital gain. There are two tax stream. So first is what you call specific, and second one is general. So what is the specific income tax rate, and which capital asset enjoy that specific tax rate, that we will see. So your what you call as usual equity share. We are talking about short-term capital gain that you get when you sell your short-term capital asset. So equity share. Then comes your unit of equity oriented fund. Then comes unit of business trust. This also we'll see what is business trust. We'll see in this lecture only shortly. So these three things, three capital assets, short-term capital, these three short-term capital gains, they enjoy the specific income tax rate, and that is 15% of capital gain. Remember this thing, very important. You are holding short-term capital asset for short period or the for the period given in the taxation law, as we have discussed here. In some cases up to 36 months, in some cases 12 months, in some cases 24 months, like this. If you are selling that asset, you get the capital, you get the profit, and that is called short-term capital gain. And for and the income tax rate 15%, then which short-term capital asset enjoy this what you call 15% income tax rate? So that is these three capital assets. One is equity shares, then second is unit of equity oriented fund, and third one is unit of business trust. These three capital short-term capital assets, they enjoy the what you call the specific income tax rate, that is 15% of capital gain. So this is one stream we have discussed, or one tax tax line we have discussed, tax method or tax rate. There is one tax rate. This is specific tax rate. Then there is general tax rate. Then when Act says, yeah, this what you call this your three assets, capital assets, enjoy the what you call specific tax rate, income tax rate, that is 15%. And what about others? Natural question, honest doubt. Honest doubt. What about other short-term capital assets and short-term capital gain? Which rate is to be applied? If I am or you are holding some capital asset which is not which is not equity share, which is not unit of equity oriented fund, and which is not unit of business trust, but some different thing. Let us say your immovable property, short-term capital, this immovable property. Because it doesn't come under these three things. The three, these three happy birds. The government has given concession to them. So, immovable property, though short-term capital asset, this specific rate is not applicable. That is 15% income tax rate is we cannot apply. Government says no to this thing. You cannot use this rate, 15% rate, for taking tax from the person who has sold his immovable property, which was short-term capital asset, and he got the short-term capital gain. So that investor should not, or you should not use that 15% rate. Then what rate you should use? So taxation law says, our income tax department says, this they say you use the income tax slab rates, that as the elder brother of Income Tax Act 1961, that is the Yearly Finance Act. Yearly Finance Act gives the income tax rate, that is called slab rate. Income tax slab rates, or slab rates of income tax. You apply those things. Or rates given in the slab system of income tax. That rate you apply for assets other than these three things, that is share, unit of equity oriented fund, and unit of business trust, and your equity shares. So there 15% is you should not apply 15% rate, but you have to apply the slab rate for other short-term capital assets. So this is very important, and just remember, note down all these things, what I am telling. Then comes long-term capital gain. And long-term capital gain, this when you sell, we know now what is long-term capital asset. Long-term capital asset, as we have seen, the asset which is not short-term capital asset is long-term capital asset. And if you sell that asset in the investment market, and if you get some gain or some profit, then that becomes your long-term capital gain. Long-term capital gain. Then here again the government to achieve that objective. Again, remember this, very important, I am repeating. You also note down, this repetition is important here for, for study purpose. So, government again, for long-term capital gain also, there are two types of income tax rates, or rather income tax rates for two types of capital assets, two category of capital assets. So first category, let us go ahead. First category of capital, long-term capital assets. First category of what you call long-term capital asset is your equity shares. Equity shares. Then your unit of equity oriented fund. Then third one is your unit of business trust, and fourth one is zero coupon bond. So remember these four capital assets, long-term capital assets, long-term capital, these four long-term capital assets, and if you sell any of these four or all four, then you get some profit or gain. So that is called long-term capital gain. And for such long-term capital gain, for all these types of capital gains, gain coming from sale of this what you call equity shares, gain coming from sale of your unit of equity oriented fund, and gain coming from your sale of unit of business trust, then gain coming from what you call sale of your zero coupon bond. These four long-term capital gain, the income tax rate is 10% on capital gain. Remember this thing, 10% on capital gain for these four types of capital assets and capital gain, long-term capital asset and long-term capital assets. These are four types, and for that rate that you have to apply, all the taxation law says you apply 10% on capital gain if you sell this what you call long-term, any one of these four long-term capital, all four long-term capital assets you sell, and your profit to be taxed, and you should pay tax at the rate of what you call 10% on capital gain, on your profit or capital gain. So this is one rate system for long-term capital assets. Then what you call for other capital asset, there is another income tax rate. So apart from these four long-term capital assets, the Act also talks about the capital asset. Capital asset where this 10% capital, 10% income tax rate is not applicable. Or in simple words, if apart from these four types of capital asset, long-term capital assets, if you are having some different capital asset, say immobile property, this is a long-term capital asset because holding period goes beyond 24 months. So, if you sell this immobile property in the what you call investment market and you get some profit, then you have to pay income tax at the rate of 20% on your long-term capital gain that that you get from sale of your this immobile property. which was long-term capital asset. So I think it is easy to remember this, what you call, in the first category, there are four long-term capital assets and rate is given 10%. And what are those four types? The unit, that is equity shares, unit of equity-oriented fund, then unit of business trust, and zero coupon bond. These four capital asset, long-term capital asset, and and gain, profit arising from the sale of this type of long-term capital asset, that you have to pay tax at the rate of only 10%, only 10%. And for other long-term capital assets, and after selling those other long-term capital assets, that you get some profit, and for that, that becomes your long-term capital gain. And for that thing, rate is what you call 20%. Rate is 20%. One 10% category capital asset which enjoy income tax rate at 10%, and there is another income tax category which says to pay the tax at the rate of 20% in case you sell long-term capital asset other than these four in the investment market, and when you get some profit and that is your long-term capital gain, you pay on that capital, long-term capital gain, you pay tax at the rate of 20%. So I think this is all about long-term capital asset, short-term capital asset, long-term capital gain and short-term capital gain, and the objectives of the government to classify these two things in what you call, in these two things in two categories: long-term capital asset, long-term capital gain, short-term capital asset and short-term capital gain, is to encourage the investment market to give what you call push or boost to encouragement, simple word, encouragement to the investor to do more and more what you call buying and selling activities of capital assets in the investment market. That is very important objective or purpose of government behind giving all this consent, reduce holding period, then reduce tax rates, all these things. This is all about what you call long-term capital asset and short-term capital asset, long-term capital gain and short-term capital gain, and the income tax rates for all these gains that we have already discussed. And we have also got the what you call the objectives declared by them, objectives, government objectives, why we are classifying into these things, what you call long-term and capital, and why we are giving reduced tax, what you call rate. All these things make the what you call this topic interesting. I think I have given justice to the topic and wish you all the best. Thank you very much for watching my this video. I will meet you again in the next video.